Hello, everybody. It's currently 5:31. Let's go. We'll start at 5:32. See if we have any other people joining in. But welcome again, and thank you for being here. We'll start momentarily. Great. So it's 5:32. We're going to go ahead and start tonight's workshop. Welcome and hello, everybody, to our credit scores workshop. My name is Alfredo Martinez, Community and Special Events Coordinator here at CBC. What we have today is this conversation of credit scores, and we're really going to be diving a little bit deeper into some of the nuts and bolts and what comprises a credit score. Who I have today speaking alongside me with me are two team members who work in the lending department here at the credit union. So I'm going to give them a brief moment to introduce themselves as they are the industry experts. Angela, would you like to go first?
Sure. My name is Angela Villalobos, and I am the Consumer Loan Manager with CBC Federal Credit Union. And I've been in the lending industry for 17 years, and I'm hoping that we bring a little bit of knowledge to assist you with your credit journey.
Thank you for that lovely introduction, Angela. On the call out tonight, we have Yesenia Garcia Vasquez. Yesenia, would you like to introduce yourself to the attendees tonight?
Hey everyone, my name is Yesenia Vasquez and I am a consumer loan underwriter here at CBC. Thank you for joining us as we learn the importance of credit. I too have many years of experience in lending and I look forward to answering your questions at the end of the presentation.
Thank you for that introduction, Yesenia. To the attendees tonight, as you can see, we have comprised a panel tonight who have history and working experience in involving credit scores on a day-to-day basis. So without further ado, let's go ahead and get started. But before we really dive into the workshop goals for tonight, I think it is important to highlight a couple things. First, let's keep in mind that the figures shown in tonight's workshop are hypothetical accounts that are based on common experiences and does not take into account the underwriting process. And I say that really because we're going to be talking about certain personas and profiles in regards to credit scores and certain experiences. And so just keep in mind that these are really simplified accounts for educational purposes. And thank you again. As you know, you have the Q&A function and the chat function here on via Zoom. So feel free to interact with us in that manner. We will be reserving a portion of tonight's workshop towards the end for Q&A. And so as you kind of continue through this, as you walk through this workshop with us, go ahead and jot down those questions that you may have. And I'm sure there's going to be quite a few. So that way we can go ahead and answer them towards the end of the workshop. So thank you. And without further ado, here are our workshop goals. So in this workshop, we were going to introduce what credit scores are and how to read a credit report. We're going to explore ways to establish, manage, and grow your credit score, and really drive in that point and understand the importance of why credit scores are in our everyday lives and why we need to take care of them. As many as you have already gone through experiences that have shaped your decision-making based on credit, whether it's buying a vehicle, buying a home, etc. So we're really going to be tackling this subject and hopefully give you that insight as we had mentioned a little bit earlier ago. So remember, your credit can have a big effect on your financial life. Your credit report provides a snapshot of your financial habits, and financial institutions, cell phone companies, credit card companies, and other companies use it to get a sense of your credit worthiness, your ability to pay back these obligations. So understanding how credit scores and reports work will help you keep your finances healthy and help you achieve your financial goals, whether it's buying a home, leasing a car, buying a car, or paying off debt. So that said, we have launched, we're going to go ahead and launch a poll tonight, the first poll of the night, and really just start gauging the room and having you interact. So right now, you should be seeing a poll launch on your screen. If you can go ahead and do us a favor and answer this poll. And the question is has your credit score improved in the last 3 months? And really, again, this is just for us to get a better understanding of, where you're coming from, what information may be more relevant. And so go ahead and to answer to your best of your ability. We're going to leave this on here for about 30, 40 seconds, and then we're going to talk about some of the results. Great. So we got we're sharing the poll results right now. Let's see, can we, it looks like it has your credit score improved in the last 3 months? 50% of you said yes, with 40% said no, and a few people said not sure. So this is good news. And what I mean by that is that folks who have actually improved their credit score in the last month, it seems like you're doing something right. So at minimum today, we should provide added context and maybe give you some of the reasoning as to why your credit score has improved. And for the people whose credit score hasn't improved, we're going to be dissecting and looking at different ways and different strategies that you can use to start improving your credit today. And for the folks that are not sure, we're going to give you some resources on where to get this information, and so that way you can start making a game plan as far as improving your credit. So thank you for answering there. We're going to be launching several polls throughout tonight, so we really appreciate the engagement there. So let's get started with the beginning of the presentation here. So I think it's really important that we all start off on the same page. So we're going to go ahead and talk about what a credit score is, provide a little bit added context here. So credit scores are a big part of financial management. Before we dive in and talk about building your credit score, let's talk about the what and the why a credit score is essential to a healthy financial life. So right here we have a credit score overview. So really, what is a credit score? The simplest definition that we have is that it's a 3-digit number summarizing your credit risk. That is how likely you are to pay back your credit obligations as agreed. Note that these credit score ratings are for informational purposes only. Lenders and other companies that use credit scores set their own guidelines. And so what you see here on this slide is this pie chart here where we go from poor to exceptional credit. As you can see, several scores are highlighted in different colors, green being on the better side and red really showing that it's not so great. So the idea here is that you want to start moving the needle in a positive direction. We want to start heading and making sure that you're on the right path to getting a good, then very good, and exceptional score. And so, like I said, at minimum, what this does for us is provide the same context for everybody here. And so we all have the same understanding of these definitions and what we have to really start learning about. Great. And so one of the most common questions and how to drive this conversation is for people who may not have the ability or are in a position where they can't get credit. How do you start building credit? What are the right steps from day one to start doing this? Many people, especially young people who have, or people who have migrated to this country, have no credit history. It's not a bad thing. It's not the same as having bad or poor credit. Although people with credit history will face similar difficulties in getting loans or proving their credit worthiness. However, there are many steps you can take to start building credit. So what we're going to do is we're going to go ahead and highlight some 4 simple steps on what you can start doing today to start building your credit if you're starting in this type of capacity. Step number 1, establishing a banking relationship. This is such an important step in not only showing credit worthiness, but building a relationship with your financial institution. At CBC Federal Credit Union, in order for us to kind of gauge the full profile, we do look at the banking relationships that we have. And then moving forward to step number 2, once you have that banking relationship, opening a line of credit. Speaking to your banker, speaking to the loan representative, can we start a relationship in this avenue? If so, what steps do I need to start taking today in order to do that? Step number 3, open with a co-borrower or be added as an authorized user, which is also another avenue, a really great step, an important way to start building your credit. And lastly, step number 4, paying all your bills on time in full and never miss a payment. We'll learn throughout the workshop how important it is to pay your bills on time and how much that can actually affect your credit score. I think it's important that we get a little bit of buy-in here. Angela, do you want to talk a little bit more about step number 3, a co-borrower or an authorized user, so we kind of understand the same language here?
Yeah, so when considering a co-borrower for signing with your loan, if you're starting out with credit or have trouble with credit, some of the things to consider is positive repayment history on their behalf, depth and seasoning of credit accounts, comparable credit to the request that you have, and possibly someone with sufficient income depending on your need for the cosigner.
Thank you for those for that explanation, Angela. I think that it's very important that, one, we understand the same lingo, and why is this important? So when we have those conversations with our representative at our local branch, it's important to understand some of these concepts. And really, what you're doing today is overall improving your financial health and also becoming financially fit by understanding these topics. So thank you again for that. I think it's really great and really important that we address this in a perspective that relates to our members and our community alike. So what we want to do now is we're going to go ahead and use Henry and really kind of put this in a perspective of a member from a day-to-day, kind of going back to my initial comment about using hypothetical accounts. So let's talk about Henry. Henry's a 20-year-old who works 2 jobs, one at a grocery store and another at a host at a restaurant. Henry doesn't understand credit too well, but is getting ready to buy a car. He has also paid bills late in the past, and one reason is that his personal finances are not very organized. We're going to see how different the car shopping experience can go for Henry with poor and very good credit. But before we move on to that, we're going to go ahead and launch another poll here that you'll be seeing pop up here. So if you can take a quick 30-40 seconds to answer this poll. And really, again, this is just to kind of help drive the conversation throughout the presentation. Great. So it looks like the poll came just back in with overwhelming percentage. 92% of you said that yes, you know your credit score. That is fantastic to hear. This is where you want to begin. Knowing where you stand and where you want to go forward is, probably the first step in raising your credit score. So as we continue the conversation tonight, apply these concepts and apply these scenarios to better illustrate what you can do today to start improving your credit score. So again, the 92% of you said yes. There's one person who said they're not sure, and then I need to check. So again, at minimum, what this does is it gives you a plan of action, something that you can start doing today, and start kind of saying, hey, what are the next steps that I need to take in order to be more on top of this? And so again, apply these hypothetical accounts to better illustrate, to better help you or aid you to understand some of these concepts. So again, we're talking about Henry here, and we're talking about how credit plays an important role in the car shopping experience. So what we have here tonight is really a hypothetical account that helps us guide this conversation. So again, what we have here is 2 profiles. We have a profile on the left-hand side and a profile on the right-hand side. So what we're going to say is that Henry wants to buy a vehicle, right? He's looking at a 2019 Subaru WRX. For those who may not be familiar with that maker model, it's a smaller sedan, sportier, on the sportier side. And what we did is we essentially ran 2 projections. We ran a projection with a 740 score and then a 550 score. You've probably already jumped ahead and seen some of the figures here down below, but the loan amount is going to start about $28,000 for this type of vehicle. And so let's start with the 740 on the A+ credit side over here. So because of his excellent credit score, he does get favorable terms, meaning that you can get lower rates, better terms as far as that term for the term of the loan. So on this score, you're going to get a 4.29%. That's what Henry is essentially being offered. He's going to opt into the 84 months term, or 7 years. And so this is where we start breaking down the projections. Look at the payment amount here. We're looking at $386.34. So the total interest here on this loan is $4,469.99. with a total loan cost of $32,469.99. Again, you might have already jumped a little bit further along, and you might have already seen the right-hand side, but you can kind of see the contrasting figures here. With the 550 credit score, which would be classified as a D credit, again, let's look at the loan amount, $28,000. But because his credit isn't necessarily where it needs to be, the lender may see Henry not as creditworthy, more of a liability, meaning that it may be riskier to lend to this individual. So they're going to give him a higher rate at 11.55. Many of you may have experienced this when you're starting off with credit, whether it be your first vehicle loan or your both home loan. But it's important to know that there are steps that you can take to improve your situation. Before we get to that, let's continue to see some of the figures here. So he opted into the same term, the 84 months, 7 years. The payment amount goes to $487.80. So you already see that contrasting difference between the left profile. With a total interest of $12,974.65, the total loan cost is really $40,974.65. I think there's something to be said here. You know, the difference is roughly a little bit over $8,000 depending on your credit profile. So when we talk about the true cost of ownership of a vehicle, or the true cost of owning or buying a vehicle, and whether it's you're leasing it or whether you're financing it, you have to understand that, you know, your monthly payment, yes, a lot of people focus on that, but there is a total loan cost to this loan. And so by understanding this concept, you can actually improve and renegotiate your loan as your credit improves. So what I'm going to do now is we're going to go ahead and launch poll number 3 to kind of hone in on this conversation. And so really the question is here is, have you ever refinanced an auto before? So let's go ahead and give 30 to 40 seconds for folks to answer this question. Great. It looks like majority of you answered the question, and it's kind of a split room. So the question was, have you ever refinanced an auto before? 48% of the folks in here said yes, with 52% of the folks in here said no. So it almost split right down the middle. Angela or Yesenia, is there anything that you would like to speak on as far as the people who haven't refinanced an auto before? You know, maybe what does that process look like? What are some of the things that they can potentially do as far as saving money or opting into better terms? Is there anything you'd like to add to that?
It's always a nice surprise when your credit has improved and you refinance the car. You can see the difference in your payment as shown here. So if you have established some payment history on your auto loan, then I would recommend, you know, many of you already know your credit score, do some rate shopping, and CBC has really low rates, very competitive rates, and I would recommend you giving it a try if you would like to reduce the interest on your loan and reduce the payment and pay your loan off faster.
Thank you for that explanation, Angela. Angela is absolutely right. For the people looking at the slide now, so really I think the main takeaway here is if you know your credit profile has been improving, there may be an opportunity for you to renegotiate your terms, and really that's in the form of refinancing. So for the folks who have done it before, maybe their payment decreased, and maybe they were able to put more on a monthly basis back into their wallets, and whether address other debts or other areas in their budget. So the idea really is that you can essentially, as your credit profile improves, is save more money and make a better deal, as shown here with Henry's upcoming purchase. And again, I think that it's important to note that this could be in the range of thousands of dollars. So if you're one of the individuals who has not refinanced an auto but currently have an auto loan, you know, maybe this would be an important time to reflect to see if you can actually opt into better or more favorable terms, and starting that conversation can really essentially put more money back in your wallet. Thank you again for that that comment there, Angela. Great, moving forward. So one of the more common aspects when it comes to credit scores and loans is really understanding what cosigning is and the cost of cosigning. So we're going to continue to use Henry in this scenario to kind of drive the conversation about what is cosigning and what are some of the costs associated with it. So Henry isn't sure if he will be able to get approved for his car loan. He has taken some steps to improve his credit and is now eligible for a loan, but he has a problem. He needs someone to cosign. Many of you may have been in this position before where you may need a more creditworthy borrower to go on the loan with you, one, to opt in into more favorable terms, or two, just to get approved. So we have a couple questions here that we're going to tackle today. Should his parent, a qualified cosigner, cosign on a loan with Henry? What is a qualified cosigner? And how will cosigning affect his parent's credit score? Angela, do you want to take a crack at these?
Yeah. So should someone co-sign with Henry? I think that based on the information that was provided, he works 2 jobs. It is possible he may need a co-signer depending on how long he has worked at those jobs, and take into consideration his combined income compared to his current obligations. A co-signer might add some strength, stability, and income to his application. And a qualified co-signer, as I mentioned, is looking for someone with positive repayment history, depth and seasoning to your credit, and someone that has some comparable credit, somebody with experience of that size of a loan previously. And again, somebody that has sufficient income depending on the need for additional income on the application. How will cosigning affect someone's credit score? There is a hard inquiry. There is a new loan reporting to their credit if the loan is finalized. And yes, they are financially responsible for making that payment, and it could potentially affect them qualifying for future loans. So the impact to their score is the same as if they applied for a new loan on their own.
Great, thank you again, Angela. So essentially, I think the important takeaway here is that there's some serious responsibility for the cosigner, and they have to understand what this is. You know, put yourself in their shoes. Have you ever signed a joint credit application, whether it be with a spouse or a family member? Or have you ever added an authorized user to someone else's credit card? Or should you add an authorized user to your own? These are all excellent questions, and these are all excellent ways to help improve credit scores. As just some added context here, what a lot of individuals do for their young, either whether it's still children, they'll add their children as an authorized user to their credit card. Why? Well, one, it gives them the ability to raise their credit without actually going through, they themselves as an individual through the credit application process. And so it's an easy win for that individual and usually the family. And so this is what this really speaks to when you're talking about co-signing. But I think that the main focus here is that there are costs to this, meaning that there is added responsibility, as Angela pointed out there. So we're going to go ahead and put this in a perspective of more of a spouse and a partner setting. So Michael and Tamika are getting married in 2 weeks. They're thinking about merging their finances by opening a joint checking account and applying for a joint credit. Tamika has a good credit score, but Michael does not. So the question here is, will having a joint credit card or checking account affect Tamika's credit score? Yesenia, do you want to take this question?
Yes. So having a checking account, a joint checking account doesn't affect the credit. Having a joint credit card does. They both have to understand that they have to pay on time. If one of them doesn't pay on time, it'll affect both of their credit scores. If they use a credit card up to the limit, it's going to affect their credit scores. So it's joint responsibility, and whatever one does will affect the other.
Thank you for that. Thank you for answering that question, Yesenia. So there you have it, attendees. You know, the answer is that it will affect as far as the credit card application is, as we're speaking in that term. And so I know that a lot of individuals often run into this at some point in their lives is, what's the best way to go about this? Having these conversations with your local representative and your local branch is another great way to get some of these questions answered. And at minimum, I hope that this inspires you, or at least, gives you that comfortable feeling that you can always come into the credit union, and we're here to facilitate any type of questions that you may have, and really be that helping hand. Before we move on to the next slide, I want to ask another question, and we should see another poll launch here shortly. So we're going to take another 30-40 seconds to launch a poll here. So the question is what makes a credit score? And this is what the next part of the presentation will be. So to the best of your ability, answer the multiple choice. Great. It looks like a majority of you had responded to the question. As I'm looking at the results here, there's no wrong answer. Everything that you see here is a part of what makes a credit score. So the answer that most people clicked here was all of the above at 75%, which is true. Payment history, outstanding debt, credit history length, pursuit of new credit, and credit mix are all factors that comprise of a credit score. So thank you for that, for answering that poll. Now what we're going to do is we're going to go ahead and talk exactly about this, what makes a credit score? And as you saw through that question here is that all of the above really play an important role in developing a credit score. So what you see here really is all the 5 factors that make a credit score. Payment history, outstanding debt, credit history length, pursuit of new credit, and credit mix. As you see on the right-hand slide here, we have this pie chart here. You see payment history with the biggest piece of the pie, then outstanding debt, and so forth and so on. So some of these factors weigh a little bit differently into developing your credit score. We're going to go ahead and talk about each of them. And I think that this is an important time for you to reflect on, where do you sit with some of these aspects, some of these factors. So let's go ahead and just start with the first one, which is payment history. Payment history accounts for 35% of your credit score, which is the biggest piece of the pie. And so what do we need to know about payment history? Well, a single 30 or 60-day miss is easier to recover from, but can still hurt your score significantly. A 90-day missed payment is more damaging and could disqualify you from certain loans. And lastly, after 90 days, missed payments can become charge-offs and be sent to delinquency. Or sent to a collection agency, excuse me. So again, I think the key takeaway here is that the payment history is the biggest piece of the pie at 35%. So how do you score an ace, so to say, in this area? I think Yesenia had some practical knowledge on this topic. So Yesenia, do you want to chime in here?
Yes, I just wanted to stress the importance of making your payments on time, even if it's just a minimum payment. You make the minimum payment, at least you're good for the next month. You're going to avoid any late fees and then trying to play catch up. And it's really important, 35%. So pay on time and avoid the late fees and playing catch up.
Great insight, Yesenia. I think one really easy win, an easy way to make sure that you score and get the full 35% here is if you were to just set your payments automatically. And how Yesenia said, take her advice and set it at the minimum payment, at least minimum, so you know that it's covered. We all have busy lives. We sometimes, have those moments where we forget to make a payment, et cetera, et cetera. But if you have the ability and you're in the position to, I would highly recommend that you at least set your payments set for auto pay at the minimum figure. Then it would be totally up to you if you want to tackle more principal by adding an additional payment. But again, this is how you score the 35% in this category. So what you see below the pie chart there is that you see like this 97% to 100%. You want to stay on the green side, meaning is if you miss one payment, that's okay to recover from. But when you start missing more than one or two, or getting below 98% payment history, that's when you start seeing your credit drop there. So keep that in mind. Again, this is the biggest piece of the pie. So if you're in the position where your credit score has not improved, are we making our payments on time? Can we set our auto payments at minimum payments, so we ensure that we can start kind of creating this better habit now, as opposed to kind of be more reactionary as our credit score fluctuates. Great. So we talked about payment history. The next big piece of the pie is outstanding debt. So what do we need to know here? Well, credit card use matters the most on for each individual card, and we'll talk a little bit more about that. It's also important to know that the average use across all your cards is important too. And the last thing is, you want to try to stay under 30%. Under 10% is even better. And remember, you don't need to carry any credit card debt to build your credit. So I want to take a second there to have Yesenia or Angela speak about the 30% utilization, as we kind of spoke about that. So would either of you like to kind of share your insight on what that means?
So 30% is the first threshold. So anything under 30% usage on your credit lines, and that is combined credit lines and individual credit lines, is a positive utilization to your credit and won't necessarily impact your credit score significantly at that point. There is a second threshold that will have a higher impact to your credit score, which would be the 70% as well.
Great. Thank you, Angela. Yesenia, did you have anything to add to that?
Just for those who are starting credit, you get your first credit card, just think before you buy. Think about how long it will take you to pay off that large item. Is it worth it? Is it necessary, or can it wait? If you need, for example, a computer for school, that's important. Just set a payment plan. Make sure you pay that off before making the next large purchase. That's it.
Thank you both for that insight. I think that they touched both on some important themes here, which is really understanding the purpose of your purchase, really. So let me put this in a little bit different context for the attendees tonight. Let's say that you have $1,000 credit card, and let's say that how does the 30% play into that? Well, essentially, like, let's say you have a $1,000 credit card, you don't want to be above 300 on that balance. But it is important to understand that it's not just any individual card, it's the average across all your cards. So as long as if you happen to have a few credit cards and they're if the limit's at $1,000 and you're above 300 on all of them, that actually can start affecting you negatively. So what is one of these ways that you can get the 30% of the outstanding debt? How can you score the highest in the outstanding debt category? Well, really is reducing that utilization. So, if you happen to have $1,000 credit card and you're at $700 limit, that's not doing you any well. Let's say that you happen to have $1,000 credit card with a $700 limit, and then let's say you have another credit card at $1,000, but there's no balance on that. You may be able to balance transfer part of that balance to the other credit card to reduce your utilization ratio, which would actually improve your credit score. So again, this is a great way to empower yourself and really start thinking about how can I maybe either one, pay things down, or maybe move my balances around to benefit myself and improve my credit score. As you see on the slide above the pie chart, there is some kind of parameters that you want to work through. So as we had mentioned, 30% and under, you're in the green, so to say. It's best practice, you're doing well. Once you go above the 30% ratio, that's when you start seeing more of the negative consequences on your credit score. So again, I think the takeaway here is that if you happen to have a credit card and you're above the 30%, try to strategize on ways to kind of reduce that, whether it's a balance transfer or maybe trying to tackle more of that debt. Whatever agrees to your budget is the best strategy there. Great. So we talked about payment history. We talked about outstanding debt. Let's start going through the other pieces of the pie. And as you can tell, they get smaller and smaller. 15% credit history length. So what do we need to know about credit history length? Well, you don't want to close your oldest credit card. It what gives you long credit history. So this is an easy win, in my eyes, a great way to boost your credit score without really doing a whole lot. It is important to know that banks and financial institutions can close an old account if it never gets used. And when an older account falls off your report, whether it's a mortgage or a student loan, your score could drop. But I think it's important to note that this is a smaller piece of the pie. So if I were to put my energy anywhere else, it would be in the payment history or the outstanding debt category. But what dictates long credit history length? If you look above the pie chart here, there is these parameters again that we go by, which is anything above 7 years. It shows great credit history length. And again, don't worry about this. A lot of this happens organically, meaning is that as you kind of go through your life stages, as you go through your purchases, whether it be an auto or a home loan, this will happen organically. And so you can usually score pretty well in this category just by kind of going through your life stages. And so again, one of the smaller pieces of the pie at 15%. It is important again to note that closing credit cards, oldest credit cards. So like let's say you open the credit card at the age of 19 at a different institution you don't really primarily bank at anymore. There is some benefit to leaving it open, is that card gives you that that credit history length. It increases the average, as that's what they look at, is the total average of your credit history. So keep in mind. Angela, Yesenia, I'm not sure if I missed anything in this area. Feel free to jump in if there's anything you'd like to add. If not, we'll move on over to the pursuit of new credit. Great. So let's talk about pursuit of new credit. What is pursuit of new credit? What does that mean? Well, ask yourselves, have you applied for any new loans or any credit lines recently? And that's what we really mean by pursuit of new credit. Opening several accounts in a short period of time can represent greater risk to lenders, especially for borrowers who do not have long credit history length. So as you can tell, this percentage of the pie is at 10%, a really small percentage of what makes your credit score. So what do we need to know about this? Well, good news, it's a temporary ding and scores usually bounce back in 3 months. Again, so if you are car shopping, home shopping, be very mindful of where you get your credit score run. I think that's one of the bigger takeaways here is that you want to plan ahead and minimize your hard inquiries. What we have seen too often or not in the credit union is individuals go shopping for their first car and they visit 3 to 4, 5 locations and they all run their credit. And unfortunately, that actually detracts from your score and can have a negative impact financially as you won't get the most favorable terms. So this is really what we talk about when you want to plan ahead and minimize your hard inquiries. A general best practice is to speak to the credit union to see if there's ways that we can kind of prepare that conversation or prepare you in a way that way you don't have to go to so many lenders or so many auto dealers and have your credit score ran, because there are some negative financial implications when that happens too much. As you can see on the bottom of the pie chart, again, we have these parameters. So how many, I guess, dings can I get until it starts really affecting me? Well, anything really after 2. In a short amount of time, if you have more than 2, again, lenders take a look at that. If there's a huge amount of inquiries in a short period of time, sometimes that represents greater risk, especially for borrowers. So keep that in mind. You want to plan ahead and have the credit union be a part of that conversation. So we could help, guide you in making sure that you make the best decisions and the best financial decisions for yourself. As we saw in Henry's case a little bit earlier, it could be literally thousands of dollars on the line throughout that life of the loan. Anything to add here, Angela or Yesenia?
I just want to say building credit, it takes a while. So for those new to credit, if you apply too many times, it does look like a red flag to lenders. It makes it seem like you're either desperate or you're not responsible with your finances. So really try to space out your credit pulls to once every 6 months, twice a year.
Thank you for that, Yesenia. Again, best practices right there from the underwriter herself. So great information. Thank you again. Moving forward, what we have is credit mix. And again, another very small piece of the pie, which makes up for 10%. So what do we need to know about credit mix? Well, lenders typically like to see that you have used a variety of accounts responsibly. And so don't fret about the exact number of mix, since you'll build these over time. So how do you kind of put this in context? So do you have a variety of credit types, meaning like credit cards, an auto loan, a mortgage, or student loans? And I think, again, it's a very small percentage of the pie, and don't worry too much about this. This is going to happen organically. As you kind of go through your life stages, as I had mentioned a little bit earlier, you will opt into credit cards, auto loans, home loans, a variety of lending products. And that's what kind of gives you the 10% of your score. So I think that the big takeaway here is that, you know, this will happen over time. As you see on the bottom right-hand side of the slide, anything above 10 accounts is good, is a good representation. It really just tells lenders that you're responsible, that you have navigated you know, several loans, and you know how to go about this. Great. Well, we concluded these are the 5 factors of what makes a credit score. And so so hopefully this kind of gave you a little bit more understanding of what elements you can start thinking about today and what you can start doing to kind of prepare yourself to have better credit scores. What we're going to do now is we're going to go ahead and talk about some of these credit myths that we see time and time again. Oh, actually, sorry, I'm getting ahead of myself. We're going to go ahead and look at a sample credit report to kind of give you a better understanding of how to read a credit report and how to navigate that. So let's go ahead and jump right into that. So what we have here is just a sample credit report. And what we want to do is give you some context as to what you want to look for and how to read it. So that way, when you get your credit report, you know what items to look for. So for most cases, the credit report will consist of 4 areas of information: personal information, the accounts, the inquiries, and negative items. So we've talked a lot about credit scores, but what about credit reports? Are they different? Your credit report is really a snapshot of your credit profile. Again, it includes the history. And every time you take out a personal loan or apply for a credit, those actions will appear on your credit report. So let's just go ahead and take some time to go through these little bit areas so you have some expectations of what to look for when you do get your credit report. The first area is the personal information. So this includes sensitive information: your first and full legal name, your date of birth, social security number, and in most cases, your most recent residence. So at minimum, you want to treat these documents as sensitive information, as you could tell, as there is quite a lot of sensitive information in here. So when you do pull your credit report, make sure that either secure of it, or if you're disposing, securely shred your documents. Again, you know, there is quite a lot of information on here. As we move forward through the personal information, we start diving a little bit deeper into some of the accounts that we have here. So as you see here in the sample credit report, you have a section B where you have account type, company, account number, balance, and then on the negative. So I think that there's two things that we want to call out here when looking at account types. You may see two of these words: installment and revolving. So we're going to define those really quick so that way you're not confused when you happen to read a report. So as an installment type of loan is really just meaning is that you set up you set up a term for that loan, meaning is that you're going to pay it in installments upon that term that you agreed upon. The most common example that I give for an installment type of loan is an auto loan. Let's go back to Henry's case. He took out that vehicle loan for 7 years, 84 months. And essentially you're making 84 installments until that loan is finished, essentially. A revolving is a little bit different. The easiest way to describe it is that you want to think of it as a revolving door. It's constantly available as long as you pay down the balance. So what is a common example of a revolving type? Credit cards. That's the easiest way to describe it for you. Let's go back to the example that you have $1,000. And then let's say you max out your $1,000 credit card and then you pay it back down. You still use it once you pay it back down. And so that's what we really mean by revolving. And of course, on the credit report, you'll see where they come from. So where is this loan at? So as an example, in section B, the installment loan is from Ford Credit, meaning that's an auto loan. And then the revolving is a Citicorp alongside account number, and usually a fairly accurate balance amount you'll see attached to that. Moving on to section C, there is a section that tells lenders and yourself, the consumer, inquiries. You know, where have your credit score has been ran, what activities have recently been happening. So usually you'll see month, date, and year, as well as the company requesting your credit reports and scores. So I'm going to go on a little bit of a tangent here, but this is also an excellent way for you to see if there's any identity theft or any fraud happening. Why? Because if your credit score is being ran and it says Texas, but you live in California, then those are some immediate red flags. So the general best practices here is that you want to familiarize yourself, so that way you know, is my information secure? And this is just one avenue that some people find that may not be the case. Tangent over, let's get back. And so we're going to talk about hard and soft inquiries. And so, you know what, I think it'd be better if you hear it from the professionals themselves. Angela, do you want to talk about maybe a little bit about a hard inquiry versus a soft inquiry?
Sure. A hard inquiry is when you are initiating a credit pull from a lender through dealerships as well. They will do a hard inquiry on your credit, which does have an impact to your credit score. Soft inquiries are typically more of an internal use for lenders or financial institutions to pre-screen you for credit offers, for banking accounts, and soft hits do not have an impact to your credit score.
Thank you. Perfectly said. One example that I think about a soft inquiry, I remember when I bought my phone last year, AT&T ran a soft inquiry on my credit score. And so just know that it's not always lenders who do this. Sometimes other businesses will. So just keep that in the back of your mind as you kind of navigate some of these experiences. The last thing that we'll see on a credit report are the negative items, and this kind of talks about bankruptcies and delinquencies. So if there is any negative repayment history, this is where it's going to be called out. You can't get around this. This will be shown as it is reported through institutions and through lenders. And really what this provides is, this provides you, I guess, a really high level understanding of, where you went delinquent, for how long. It also lets the lenders know that maybe you have some history, some past, or some hardship through these times. So the idea really is that a credit report really gives us a financial profile, a snapshot into you as a consumer. So that way the institution or the credit union can make decisions based on that. And so these are the 4 primary pieces of information you'll find on a credit report. And for summary, personal information, accounts, inquiries, and negative items. So we learned about how to read a credit report. Who are the players in the game, in the credit score world? There are 3 bureaus that we have to know. We have to know Equifax, TransUnion, and Experian. Why? These are the 3 credit bureaus who administer credit, and lenders and institutions all over the United States use a variety of their services to get a sense of creditworthiness. The more commonly used in the banking world, specifically in credit unions, is Experian. And so the Experian is usually a little bit tougher. They grade it a little bit harder. So for any individuals in the call tonight who may have apps like Credit Karma or may have other ways to achieve their credit score, you may have seen that difference. You may have seen the difference that Equifax and TransUnion is a little bit higher than my Experian, and you're thinking, well, why is that the case? Well, really, the criteria that each of these bureaus use to evaluate your credit score are different. And so based on that information, lenders and institutions have ways to get more accurate reporting in that regard. And so if they have a specific product in mind, maybe they'll pull an Equifax report, or they may pull an Experian. So, don't fret too much about, it being too different. However, I would place a little bit more importance or priority on the Experian score, is that one tends to be more generally used across the industry. Note that you can get a free report, and which we'll talk a little bit more in the slides to come. Usually you can get a report in the cases of fraud, if you need to apply for social services, or if you've been denied a loan or credit application. These are all ways to get credit reports. And as a matter of fact, again, we'll give you some resources at the end of this presentation for you to take. That way, if you did want to get your credit report, you have the means to do so. So great, we talked about the 5 factors. We have talked about how to read a credit report. I think it's important for our community to really understand some of the myths that are going on and how do we address these. So what we're gonna go ahead and do is we're gonna go ahead and move over to and really dispel some credit myths here. And what we're gonna do is launch a poll here to really gauge the room to see where is our understanding right now. So you should see a poll launch here in the next 30 seconds or so. And again, we're gonna go ahead and give we're going to give folks about 30-40 seconds to answer. So the question is, the ask is credit repair companies are always helpful in correcting errors and taking other measures to improve a person's credit score. Is this a fact or a myth, or are we not sure? Great, I see the responses coming in. So I see some folks hit fact, some folks hit myth, and some hit not sure. Majority of you at 45% said not sure. 36% of you said myth, and 18% of you said it's a fact. So let's go ahead and address this now. So as a matter of fact, this would be a myth. And why is that? So let's talk a little bit about that. Experts agree that credit repair companies often overpromise, charge high prices, and perform services such as correcting credit report inaccuracies that consumers could do themselves by just contacting the lender and the credit bureaus. So I think it's very important to understand that while some of these services will assist and will help you and may seem very convenient, be very mindful as these types of folks aren't really organized in the sense that you see this across every credit repair company. Each credit repair company may have a different fee schedule, may charge differently, may overpromise. So what is the best way in getting assistance, or where do I go when I find myself in this situation? Well, first and foremost, go back to the credit union. See what we can do to kind of help you. If there's a way that if you do need help correcting errors, we can at least give you the right information on where to go and give you the resources you need. So again, I think the key takeaway here is that be very mindful if you do engage any of these credit repair companies. As experts have said, that they often overpromise, charge high prices, and perform services that you, the consumer, can actually do. Great, let's go ahead and talk about another one. So here's the question. Is it easy to improve a credit score? It is easy to improve a credit score and take a short amount of time. Well, that's really a myth. And we're going to go ahead and talk a little bit more about that. So the facts are that since the process of increasing your credit score is dependent on your financial profile, it is best to view this process as completing the steps by the steps below. The average consumer can see their credit score increase anywhere from 10 to 30 points every 6 months if they adopt these measures. So what are some of the things that we can do? Check your credit report and dispute every error that you find. Pay your bills on time. Late payments stay on your report up to 7 years. And pay off your credit card balances. This will reduce your credit utilization ratio, which will do wonders for your score. So again, this kind of goes back to some of the factors that we talked a little about earlier. And so then you're in a position where you can strategize and really take care of some of these concerns that you have. Stop applying for credit. Hard inquiries ding your credit for up to 12 months. So if there's no need to apply for credit, if you're at a department store and they say, hey, we'll give you 10% off if you apply for credit, just remember that you are doing a hard inquiry and that may negatively affect your score. So keep that in mind, when you're out as a consumer shopping or buying services. Try to settle delinquencies with lenders or collection agencies. So if you've happened to have a hardship in the past and you didn't have the means to either pay down that balance, maybe start the conversation back again and see what you can do to take ownership of that. And the idea is that it would be on your credit report as a resolved or a work in progress, ultimately helping you out as a consumer. I believe I have a couple more myths here. And actually going to launch, I believe, the last poll of the evening, which is not opening any credit will help me reach my financial goals down the road. So go ahead and take about 30 seconds to ask this. Do you think this is a fact or a myth or not sure? Great, I see a lot of the answers coming in, and it looks like the overwhelming majority says that this is a myth. 67% it's a myth, 11% said it's a fact, and 22% are not sure. So let's go ahead and address this. So the fact is that it is well known that having a good or improving credit score will make it easier to attain your financial goals. Developing a credit score at a younger age will make it easier when you want to move into an apartment, buy a car or a home, or need an emergency loan. So this is something specific that I have came across. There is this misconception that, you know, I'd rather pay cash up front. There's no need to take out a line of credit. Well, unfortunately, or however you may feel about it, a lot of the things that we do as far as our activities, our financial activities, are very dependent on credit worthiness. And so, meaning that if you're a college student that, you know, wants to go to college on the East Coast, you know, when you move into an apartment, a credit score is a factor in that. Buying a car or home, credit scores are a factor in all of these pieces. And so, whether you may not be the type of individual or consumer that likes to put things on credit, you strategically will probably have to, so you can achieve some of these milestones. I think it's very important to understand that not just for ourselves, but for the young people in today's call, or if you know any young individuals, that this may be pieces of their educational path that they may have to start thinking about, so they have all the pieces so they can make some of those transitions or activities. Great. So we now have talked about the credit score factors. We talked about reading a credit report. We talked about addressing some myths. Where can we start? Oh, it looks like we have one more myth. The decision to grant a loan is based solely on the credit score. So let's talk about this really quick. No, a credit score is just one part of a number of factors that lenders examine in a process called underwriting. So the credit score isn't the only factor. Underwriting criteria can vary and are driven by lenders' businesses. Among the criteria beyond credit scores that a lender may consider are down payment, income, employment history, and cash on hand. Angela, do you want to speak to this? Is this something that CBC does?
I do apologize. I was answering questions. Let's see. There are several parts to a decision other than the credit score. So we take into consideration time at residence, time on job, income, the credit history. Credit score may drive an interest rate assigned to you, but it doesn't necessarily drive the decision.
Wonderfully said, and really easy to understand. So thank you for that. So I think the takeaway here is that credit scores are very important, but aren't the only factor in determining approval. And so, as Angela pointed out, some of the factors that are. So keep that in mind as you kind of think about your own personal credit score. And so ways that you can either be more favorable terms, or based on the relationship you have with the credit union, those do go into play. Thank you again for that. So again, so we talked about the credit myths, we talked about how to read a credit report, and we spoke about the 5 factors, and we kind of put that in the perspective of a young person, Henry. So where do we go to get some of this extra education, or how can I start, being a little bit more proactive about my credit report? And so a really easy way to do that is to get your free credit report. I have listed here, annual credit report. I would highly recommend that you visit the website. Calling can sometimes be a little more difficult to reach individuals, but essentially as a consumer, you're allowed a free credit report per year. You could also get your credit score through the 3 major credit bureaus, which is TransUnion, Experian, and Equifax. They do have services where they may charge, so that's totally up to you. But if you wanted to use the free service, annualcreditreport.com is the way to do that. As a matter of fact, I had several individuals reach out before tonight's workshop asking where can I get my credit report, and I directed them there as you can get a credit report from them free. If you have to be on the other side where you may say, hey, I want a little bit more services, I want to understand this a little bit better, where can I go to get some counseling perhaps? The National Foundation for Credit Counseling, I listed the website there for you, so feel free to reach out to that and learn more about this topic. The Financial Coaching Association of America also has tons of free resources for individuals wanting to learn more about this or ways to improve their credit score. And lastly, the last call out that I want to give out is that if you are a member tonight, if you happen to be a member of CBC Federal Credit Union, you can access your credit score through your Epic Premium checking account. And so if this is news to you as a member, come into a branch, give us a call and ask us what is an Epic or Epic Premium checking account. They come loaded with a ton of benefits. And one of the benefits added to them is that you do get your credit score given to you. And so you do have that monitoring available through these checking accounts at the credit union. We are approaching, it's currently 6:31 and we've approached the end of our workshop. And so I'm going to go ahead and recap the workshop goals here. So in this workshop, we introduce credit scores and how to read a credit report. We explore ways to manage, grow our credit scores and establish credit scores. And we also just tied in the human element. So we want to understand the importance of credit scores in our everyday lives. I really want to take a second to thank our panelists tonight, Angela, Yesenia. Thank you so much for your added insight and value there. I want to give a special thanks to Heather Waters behind the scenes, driving the presentation and the deck behind, helping it run smoothly. We've reached the end of tonight's presentation. What we like to do at the end of the presentation is really open up the conversation for any questions and comments that you may have. We have, again, Angela and Yesenia from the Consumer Lending Department here at CBC Federal Credit Union. So really the floor is now open to the attendees. We're going to continue to take in the questions that we see come in, and we're going to address them publicly so everybody can understand and hear the questions that we have. So we're going to go ahead and sit tight here. Please shoot your questions through the Q&A function, and we'll go ahead and address them as they come in. It looks like questions have been coming in, and they, for the most part, have been answered via messaging here. I see quite a few open questions here. Let's see. The first one that I see is says 709 credit score, no late payments over 9 years length credit history. I pay over the minimum amount on credit and on a credit card and loan. Why do I receive no approval for consolidation? This was not at CBC. Angela, do you want to address this question to all attendees?
Sure. I was just typing a response. I think that I need more information in regards to this question and to better answer it. So I would suggest reaching out to me offline over the phone or through email, and I can get a better picture of your situation so that way I could answer your question better.
Great. Thank you for that, Angela. We're going to go ahead and move forward with some of the questions. The next one that I see is that the only place I see credit scores are on my Discover card credits, card statement, but I like to check other resources. Thank you for your question. We call out a few other places that you could go. You have the annualcreditreport.com. If you happen to be a member with CBC, you have the Epic and Epic Premium method as well. Some of the other, on top of my head, some of the other areas that you can look as an example is Credit Karma. You got to be very mindful that some of these applications or areas where you get your credit score aren't always Experian. They have their own simulated score software. So just keep that in mind. I would highly recommend for the person who asked this is if you would like to look at other resources, call us, visit one of the branches. We can absolutely help you in finding where you need to go, and that way we can kind of get you the information that you need. I see a question here. If a bank is advertising a 2.85 refi loan, what are the prerequisites to get a 2.85? I think that that question needs a little bit more context, and what I mean by that is that we need to understand is that usually the fine terms is where you kind of get some of that information. What are the prerequisites? Angela, do you know do we have a 2.85? Do you think they're talking about CBC?
I think they're just asking maybe a generic question. 2.85 is not one of our current rates. But like you had mentioned, down in the disclosure, it will give you a little bit of guidance if that includes any type of loan discounts to setting up for automatic transfer or having some sort of banking relationship with them already, even opting into their type of insurance coverage. So I would recommend looking at the disclosure at the bottom of the advertisement.
Thank you for that insight, Angela. Let's see. There's a question, can we get a copy of the presentation PDF via EM? The presentation will be uploaded to our website as well as a resource guide. So you'll always have that resource available to you to go back and watch and take notes. But we will not be emailing the presentation, but you will have access to it via our website. So I'm hoping that that covers your bases there. I see Experian goes up to 850. Could that be a reason why it is lower than another model rather than tougher scoring? Angela, Yesenia, do you want to provide a little bit more context to that question?
So there are different ranges of credit scoring based off of the models that each lender uses. Credit reporting agencies have multiple score models. It just depends on what target the lender or institution is looking for. So I wouldn't necessarily say that it's a harder scoring or not. It just depends on the other credit that you have on your credit.
Thank you again. I see another question here. Yesenia, maybe you can provide a little bit of information. If you don't have any credit card, will you have a credit score?
No. So in order to generate a credit score, you need to have an open trade for at least 6 months.
Thank you, Yesenia. Very, very simple. Appreciate that. Going down the list, I see another question. Does CBC Federal Credit Union offer loan discounts for lower loan to value ratios? Angela, do you want to take this one?
We do not have discounts for certain loan to values. We do have a rate discount for having our premium checking account, along with having your payment set up on automatic transfer from that checking account.
Thank you for that, Angela. Going down through the list, somebody's calling out social credit score. So on some of the alternative news sites, there's mention of a social credit score. Has anything been mentioned to you regarding upcoming social credit scores? Not quite just yet. Angela, do you want to talk a little bit more about that?
I am not familiar with the social credit score. I'm not really sure what is factored into that, and I'd have to look into that.
Thank you. How does a HELOC affect FICO? Yesenia, Angela, any thoughts on that question?
A HELOC is more or less a secured credit line. So it teeters between a revolving line and a mortgage. So depending on how much of that credit line that you're using, it can impact your credit score like the same, like almost like a credit card or a line of credit would.
Thank you again for the answer. I see a question here. Can I get a cash out refinance loan on my property, which is valued at $850,000 and I own nothing on it? However, my credit score is only 650. What do you think would be a great next step for this question? What can they do, Angela, to maybe get this question answered?
I would recommend, it sounds like this is a mortgage or some sort of home property. I would recommend you reaching out to our real estate department to have them review and guide you with that answer.
Great, thank you for that answer, Angela. as you all know, for those that are in attendance tonight, you were sent a registration email. So there is contact information. It does take you back to our website. So feel free to find the channels that you need to get some of these questions answered. Or if you would like to reach out to us, we're here to help. The last call out that I want to give as well is that this will be again posted on our website. And so you will be able to review this again. And that way you can, if you wanted to visit this conversation again, you're more than welcome to, as well as a resource guide, which kind of highlights some of the things that we talked about tonight. Again, that will be found on the website of after we finish this presentation, it will take you to the website. So you feel free to check that out there. And then the last thing I want to say is that you will be getting a survey for the folks that attended tonight. If you can do us a favor and just leave your thoughts and comments in that survey, they really help us guide our workshops and help us give very detailed and member-specific conversations regarding these topics. So I really appreciate if you take a couple minutes to fill that out. It's only 4 questions, and so again, we would really appreciate that. It's currently 6:42, 12 minutes past the 30 mark. We want to thank all the individuals who took time out of their evening tonight to attend tonight's workshop and really engaging with us. Please remember that the credit union here is to make it easy. So at any time, feel free to reach out, as we're here to support and assist you in any of your financial goals that you may have. Happy to help. And so that said, I'm going to go ahead and close off that evening. Again, thank you, Angela. Thank you, Yesenia. And thank you, Heather, for helping facilitate this awesome workshop with us tonight. Hope to have you again. And I don't know if you want to say any last, any goodbyes or last words to the folks here on tonight.
Just thank you for attending. Thank you for your interest, and we look forward to the next one.
Yes, thank you. Call us with any questions.
That said, everybody have a great evening. Thank you again for your attendance tonight. I'm going to be closing off the call here. And so again, we appreciate that. Thank you so much. Have a good night, everyone.